All right, everyone. Thank you for joining. Thanks for your participation. A very good evening to you on behalf of NCM Group. Today is 27th of June, 2024. Before we proceed further, let's get to know each other. Just tell us in the chat box, what's your name, what do you do, and where are you joining this webinar from? Where are you located right now? Let's have some comments here. Today's webinar is going to be a very interesting one. I have one important major responsibility today. That is to make sure you get your time's worth. You know, time is more valuable than money. We are living almost in GCC countries. Money is not an issue. If somebody asked us to buy any meal, there's no problem. But if somebody asked you to spend a day with them, this is something that you would have to think of multiple times. So time is more valuable than money. So let's hear from you. So let's hear, everyone. This is an interactive webinar. I'm going to be talking not that much. Maybe the first few minutes of the presentation are going to be theoretical. The rest are going to be, you know, some technical stuff, some practical stuff. We're going to have amazing activity also. So where is everyone joining from? We've got a lot of participants here. Mr. Salman, great. Mr. Salman has joined us from Dubai. He's working as marketing professional and learning about trading. Welcome, welcome, Mr. Salman. Who else? We've got Mr. Kevin also. We've got Mr. Amir, Miss Fatima. So let's hear from you, everybody. Miss Anusha is also there. Mr. Faraz, Mr. Avinash, thank you for joining. So just let us know, where are you joining us from? Just one person? Mr. Kevin is from Dubai. Thank you for joining. Mr. Amir from Dubai as well. Amazing, amazing. Great. Mr. Faisal from Dubai as well. Miss Rahma from Dubai. Mr. Yusuf Ayub from Kuwait. Wow, we have people joining from Kuwait as well. That's nice. That's nice. Avinash from Dubai. Mr. Amr Zidan from Dubai. Amazing, amazing. That's cool. Everybody, now listen. I'm giving you two options. Okay? The first approach is a formal approach. I'll just read from the PowerPoints, from the slides, and conclude today's webinar. It will take hardly 40 minutes, 30 minutes or less, and the job is done. But if you really want to learn something, you want to improve your trading experience, you want to gain some reliable knowledge and value, then this session can stretch more than 45 minutes. So please let me know in the chat box. Shall we use the formal approach to keep it less than 30 minutes? Or if you really want to learn something that's going to help you in your future trading, okay, let's go for option 2. So write option 2. If you want me to take it slow, nice and easy, I'm going to use very easy and simple words. I'm not going to use any technical or difficult language to show off my trading experience or my trading knowledge. I'm going to use simple words. So what I want you to do is that grab a piece of pen, grab a piece of paper, relax, just lie down against your chair. It's my job as an instructor, as a trainer, as a teacher, as an educator to make sure all of your concepts are clear. And at the end of session, we're going to host a question and answer session. In the circle of respect, whatever questions and concerns you have, you may ask. And we are also going to do a competition as well. Option number 2 from Mr. Akash, Mr. Amr Zidan, also option number 2. Kevin, option number 2, Mr. Kevin, thank you. Great, great. Khalas, the vision is clear. So let's get started. I have designed today's presentation in a very systematic way. The first part of the presentation, the first 10-15 minutes are theoretical. It's more talking. And after the first phase of the presentation is finished, we will move into the technical part, where we'll talk about the charts, about the trading platform, about selecting a brokerage, what you should know, and what you should be careful about, how you should protect yourself from the scams. And at the end, purposely, I kept the price action trading strategies for you, but this is part 1. All right. So please, if you're joining for the first time, or if it's your first time in the world of financial markets, keep in mind, what is the definition of trading first of all? In very easy words, trading is an act of buying and selling. That's it, nothing more than that. And in business, there is a rule: you should buy always cheap and sell expensive. That's a simple rule of a business, right? But if you bought something expensive and you want to make money off it, you have to sell it at a more expensive price. So let's move to the official PowerPoint presentation. Let me know in the chat box if you can see the PowerPoint slides. Please confirm with me. Can you see the PowerPoint slide? Is it there? That's our topic. This is our topic today. Master Trading with Price Action, Part 1. I'm Masin Khan. I'm the head of the Learning and Education Division of the NCM Group. First of all, a quick disclaimer. Just pause for a while. Just take a few seconds. Read the disclaimer. Financial trading is risky. Please do not invest money you can afford to lose. Do not invest your children's education fees, your car installments, your medical expenses fee, etc. So make sure you don't invest money that you can afford to lose. We also offer practice accounts, demo accounts that you can use. And once you're confident, you can even switch to a live account at your own personal discretion. So that's the disclaimer, a quick disclaimer in words by myself. Now, these are the topics that we're going to cover for you today. We're going to talk about what are the international financial markets, what are their types. Very briefly, we'll do an express review. Then we will talk what is the role of a regulated broker and why a regulated broker is important, and what's the difference between a regulated broker and an unregulated broker. All right? And what are the disadvantages of trading with unregulated brokers? Then we'll give you a brief definition of what is price action. What is price action in easy words? Then we'll talk about what are some of the basic price action strategies used by professional traders, and what are the effective price action trading based on money management. Now, money management and risk management, they look like fancy words, but they're not that sensitive at all. You don't need a commerce or business administration's bachelor's or master's degree to understand these terminologies. Basically, money management means how you distribute or make portions of your trading capital. We'll talk about it when we reach this section. We'll talk about risk management strategies. Now, risk management strategies is something that very important because this section will teach you and explain you how to increase the probability of winning in online trading. Okay, then we'll talk about the price action strategies and techniques we teach you. We'll talk about how to use them for your entries and how to use them for exits. The last will be optimizing your trading outcomes, and then it will lead to question and answer session. Just in the meantime, okay, I'll go to that part later. Now, there are many kinds of financial markets, but the most important are the 5 to 6 markets that you're seeing here on the slide. The first market is called the Forex market, and the word Forex, it stands for foreign exchange. Foreign exchange markets are the markets where well-known and leading currencies of well-known countries are traded. If you go for shopping or something, you want to buy stuff, there's a market for each and everything. There's a market for clothes, there's a market for dry fruits and stuff, but things that are more expensive in value and they are traded in bulk, these kind of things are always traded in financial markets. The first one is Forex market, and you have almost 7 important currencies that matter a lot in the world of Forex. If you want to write it down, go ahead and write it down. The first currency is the American dollar, the United States dollar with the symbol USD. Each and every country, no matter how strong they are, how amazing is their economy, how great is the performance of that country's exports and imports, but all the international transactions are done in the American dollar. The second important currency in the world of Forex is the Canadian dollar with the symbol CAD. And Canada is not only a robust economy, they're also a country that are backed up by oil. The third one you have is the Swiss franc, which is backed up almost 25% by gold. Then you have the Japanese yen, and Japanese, of course, they're quite well known for producing automobiles, electronics, etc. Then we go to the Australian dollar. Australia is also one of the leading gold producers. You've got New Zealand dollar as well, and not to forget the GBP, the Great Britain pound, the British pound. That is what is traded in Forex with different currencies against them. Then second type of markets that you have are energy markets. Energy markets is an area in the world of financial markets where you have trading products such as the US oil, natural gas, heating oil, etc. Then the third markets are the precious markets. Everyone, if you have a prior experience, a previous background, I would request to be patient a bit. Maybe you know these things from before, but it's good to do a revision, okay? So the third market is the precious metals market, where we have gold, silver, copper, platinum. These are the important metals that are traded globally. Fourth one is a mistake. It should be equity markets. It's written energy markets. My apologies for that in advance. So equity markets are the markets where the shares of leading companies that have market capital of billions of dollars are traded. And then the last one is an index market. What's the quick definition of an index? Index is a chart, or index is a trading instrument that is used to measure performance of multiple companies and their shares combined together in one form. So these are important kind of financial markets. Again, apologies for the mistake. One of the other financial markets and its type is the agricultural markets. Agricultural market is an area where you have products like sugar, soybeans, coffee, rice. These things are traded in the agriculture markets. Now, let us talk about the role of regulated brokers. Okay, first of all, what does a broker mean? A broker can be a person, it can be an entity, it can be a company. It is an intermediary or a middle entity whose purpose is to make sure transactions, trades, deals, orders between two parties is executed successfully, fairly, ethically, smoothly, legally. Okay, now we have two kinds of brokers in this world: regulated and non-regulated broker. Regulated broker is an entity in which a governing body, a local entity by a government, is established to audit and monitor that all the financial transactions or all the financial activities are going as per the law, as per the regulations, as per the rules. Having a regulated broker means that your funds are safe and the government is also policing them for you. In UAE, we have ESCA. In Kuwait, there is Capital Markets Authority of Kuwait, and different countries have different regulating bodies. So let's read the quick official definition from the slide. Trading with a regulated broker protects your hard-earned money. They operate under strict rules, strict guidelines, strict compliance, strict policies, ensuring your funds are segregated and you're less likely to be scammed by a fake platform. Now, most of people are going through this issue nowadays on the internet. You know, they opened a trading account, they deposited the funds, the company did not exist. And when it came to withdraw their profits, make withdrawals of their money, you know, they never got it. The website got closed, or the companies, they stopped replying to their clients, you know. So that's the key difference or core difference between a regulated and a non-regulated broker. So wherever you're living, make sure if you're interested in trading or continuing your trading journey, you are always having an account with a regulated broker. Now, you know, there is a team, if you have any questions, just leave them in the chat box. At the end of session, I'm going to answer everything for you. I'm just going to switch to the whiteboard quickly, just to explain you something. Something very cool about regulated brokers. There's a concept of called segregated accounts. Okay, what are segregated accounts? In a regulated broker, the regulator enforces upon the brokerage firm or financial services provider that if this is a company, they should have two different bank accounts. Two different bank accounts. Why is that? Why is that? The first bank account is the company's bank account. The purpose of this account is to ensure, the company is this is the company's bank account for paying their expenses such as their rents, utility bills, salaries of the employees, miscellaneous expenses, etc. The second bank account is for clients' funds. Why? This is for the safety of funds, for the safety of the clients, that in case, God forbid, something happened, the money of the customers is always secure, no matter what happens, any geopolitical instability, economical instability, or civil instability. That's the benefit of trading with a regulated broker. Okay, so let's go back. Let's close the whiteboard. I'm sorry, the Zoom got updated a bit and the controls a bit different. So my apologies for that. So let's go back to our PowerPoint. So we've discussed so far what are the type of financial markets, what's the role of a regulated broker. All right, now I'm going to talk briefly about the NCM Group. First of all, NCM Group it's headquartered in Kuwait. We have regulated offices in Dubai under NCM Financial Services. Here is the addresses there. The company has a physical location where you can even meet the sales team, the customer service team, operation staff, and to ask your queries and concern. And in all countries, we have offices in UAE, Kuwait, Turkey, Jordan, and Malaysia. We have the top licenses from the regulators. From in each and every country, we have an office. So the company is since last 13 years. In Kuwait, we are regulated by the Capital Markets Authority of Kuwait. We are regulated in Turkey as well. We are regulated in Malaysia, and we are regulated in Jordan. All these 5 countries. So the addresses are there, the websites are there. You can, if you wish to visit, because the part 2 of this presentation will be hosted in the following week in our offices physically. We'll tell you what's the criteria for the upcoming webinar. Okay, so we are well regulated, we are well reputed, and we are one of the pioneers in the GCC region. Now, let's read once more. Difference between a regulated and non-regulated broker. Regulated brokers follow government rule. This means your funds are usually held securely. I've explained you this in the whiteboard. And there's a dispute of resolution process if something goes wrong. Unregulated brokers have no such oversight, putting your money and fair treatment at risk. We all know this. How is the webinar so far? Let's take a pause. Let's take a pause. How's the webinar so far? Is everyone enjoying it? Are you learning something? Or is it boring? Let me know in the chat box. How is it so far? Is it okay? Great. Thank you. Thank you for confirming. What about the others? Only 2 people are replying. Are you grasping stuff? See, trading is 95% psychology, 5% is this trading strategy. It is very easy to learn the trading strategy, but to enter in this world, the first and most important thing is, even if you're willing to enter the world of financial markets, the first crucial thing is to make sure your broker that you're trading with is regulated. They are well licensed. They have all the necessary licenses to make sure things go smoothly. So the protection of funds come first. Then the second part is knowledge, education, and development of trading skills. Then you use your funds. Now, how can you know by yourself if the financial trading firm is regulated or no? Always go on the website in the About Us section or in the footer of the website. They will always mention their commercial license number and their registration number with the regulator. If these things do not exist or openly or transparently on any financial trading website, that is a red flag for everybody not to go into those businesses. Now, before we proceed further, I just have one task for everyone. Just go to your browser, go to this website. I want you to go to our website, ncmfinancials.com. I'm going to write this in your chat box. Go to ncmfinancials.com and just visit and open this link. And once you go, download the trading platform here. It says download MT5 on the right corner. Can you all see that? Download MT5 trading platform. Just download this trading platform and try to install it while I'm giving the presentation, because at the end of session, I'll tell you we're going to have a competition and how you can participate and how to send your results and what you get for that. Okay, let's go. So please go to ncmfinances.com, download the MetaTrader 5 trading platform, and try to open a demo account. I'll guide you through the process later on. Okay, so what is price action? Markets, they move in cycles. Let's go back to the whiteboard. Let's go back to the whiteboard. The market has cycles. There is something called an up cycle and there's something called a down cycle. Can everybody see the whiteboard? Market goes up, market goes down. Market goes up, it goes down. There are cycles. But the market never goes up straight. It doesn't go up straight. It doesn't go down straight. The market, it always goes in symmetry. It goes in zigzags. It always comes down in zigzag. It doesn't go straight up. It doesn't go straight down. Okay, so this movement, or when the market is in the momentum of in a momentum of an upward direction, we say the market is an uptrend. So this here is clear. Where is the eraser? Let's go clear the page here. So if the market is moving in such direction, we know that the market is an uptrend right now. It's clear. Uptrend is also called buy trend, okay, or bullish trend. This movement that you're seeing, this zigzags that are forming right now, this is the price action. Price action simple means that when the prices are moving up and down, this action that is happening, its movement, how much it's going up, how much it's going down, how many points it has moved up and down. The monitoring of all this process is called price action. And this price action is then converted into chart. If it's sounding like a rocket science, I'll make it easy for you in the slides. This is what's interpreting and converting these price movements in form of chart. This is called price action. All right. So this is something called, this is an uptrend. You see, let's suppose the price started from this area. Now we are going to get into something serious. Okay, so everybody, before you can relax, you can keep your backs against the chair, but now I want you to pay some attention. Okay, so let's consider that this was the starting price, starting point. We can call this, it is a low. Then the price of this asset, it can be anything. It can be oil, gold, it can be a euro against dollar currency, whatever. The price went up, it made a high here. It made a high. So we call this a high. So market always goes like breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. This breathe in that's happening, we also call these corrections. We also call these corrections. So the market went from lowest price to the highest price, then it made this pullback, this breathe out thing. You see, this pullback that happened, this is called a higher low. It's called a higher low. Why is it called a higher low? Because after a highest peak it made, when it came back down, it was higher than the previous low. The new low formation was highest than the previous one. Okay, then it went up, it broke the previous high. This high was broken, then you have a new high. This new high is called a higher high. This new high is called a higher high. Okay, when you have more than 2 higher highs or 3 higher highs, it means that the market is an uptrend. The pressure is towards the upward direction, and when the market is going up, it means buyers are in control. If you want to write this down, go ahead and write this down. If the market, we are not sharing, screenshot is not showing in mobile phone. Please just restart your program. Everybody, can you all see the white screen? Can you let me know in the chat box? Can you see the white screen? All right, if you're not seeing the, okay. The gentleman who cannot see the white screen, please just close your platform or start it again, because everyone's able to see the screen. Okay, so if you have more than 2 higher highs, it means the market is an uptrend. If the market is moving upwards direction, it means buyers are in control. And what does buyers in control mean? Now, here is the key point. For the market to keep pushing upwards, for the market, thank you, Mr. Kevin, thanks for confirming. For the market to keep pushing upwards, to keep rocketing in an upward direction, the fuel that the market needs is fresh injection of cash. It needs fresh investment. It needs money. If the market is going up and it keeps on going up, it means people are greedy. When people are greedy, they want to invest, they want to make money, they keep on putting their money in the market. So this new money coming in the market is something that pushes the trading instrument towards the upward direction. Hence, this is something that creates a positive or bullish price action. Okay, we will learn this on the chart as well, on the trading platform as well. Just take it as a theory for the time. Okay, so multiple higher highs, multiple higher lows indicate that the market is in upward direction. Now, a small tip. If you want to look and seek what is the market bias, where the market is trying to move, is it bullish or is it bearish, is it towards upward direction, it's in a downward momentum, always use a minimum of a 4-hour or a daily chart time frame. I'll repeat it again. If you want to write it down, go ahead. If you want to know what's the trend of the market, what's the market bias, use a minimum of 4-hour chart or a daily chart only to know what is the market direction. To know the trend, you should always use a bigger chart like a 4-hour chart or a daily chart or even a weekly chart. But if you want to cheat, but if you cheat, you cheat with yourself. But if you want to cheat, you can use also a 1-hour time frame. Okay. For entries, if you want to enter a trade, which we will learn at the slides of price action, entry charts are the charts of 30 minutes and below. 30 minutes, 15 minutes, and 5 minutes. If you're a complete beginner, I do not recommend that you practice on a 1-minute chart or a 5-minute chart. Stay with 15 or 30 minutes for a few weeks. Build your confidence, then think of moving to 1-minute chart, because the 1-minute chart is quite fast. Okay, so we've talked about the bullish trend. Now let's talk about the bearish trend. A downtrend. A downtrend is the opposite of the uptrend. This was the highest price. It fell down. The market is starting to bleed. It goes up. Then it goes, this is the highest price and this is the lowest price. This is the lowest price. This is a high and this is a low. This is a low. Okay. People, please try not to mess with the whiteboard. It will distract me and I'll lose focus. And if I lose focus, whatever value I want to deliver, I'll forget that. Okay. So kindly do not draw on the whiteboard. I forgot to disable the annotations for everyone. Okay. So now, then the market makes a new low. It makes you remember, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. each new low that is being formed, this is called lower low. This is called a lower low, and usually traders mark it with double L. Okay, when you have 2 or 3 lower lows on a bigger chart, like a 4-hour chart, on a daily chart, it means that the market is in a downtrend, and these highs that are being formed, they're lower than the previous highs, so we call them lower highs. They are the opposite of the uptrend. Now, let's stop the whiteboard quickly. Let's go to the screens. Stop share. Okay. Why do markets start to decline? Why do markets start to fall? Now, another important tip that I'll give you, okay? If you're using green and red candle bars on your chart, if the market is in an uptrend, it's moving up, you will see that the quantity of green candles, is higher and more than red candles. Okay, it's higher and more than red candles. If also the length of green candles will be bigger than the red candles, and the red candles will be quite tiny, quite compressed. They'll be like little tiny dwarfs. Okay, so that's a tip. Now, why do markets fall? Why does market start declining towards the downward direction? Why does it crash? Why does it start bleeding? In a downward trend, first of all, when people start putting their money in the market and the market start to push towards the upward direction, right? But eventually, always have a trading goal, always have an investment goal in your mind whenever you decide to invest and trade with your hard-earned cash. And later on, you have to pull out the funds. It's very simple. If for example, if I'm a trader, I want to trade, I want to make money. And when I make money, I want to withdraw, I want to enjoy, I want to have fun, I want to travel, I want to spend, I want to buy stuff, right? Okay. So when people start pulling money from the market due to personal reasons, due to geopolitical instability, or due to economical crisis or civil crisis, whatever it is, when there is fear in the market, people or the traders will start pulling out their money. This will lead to the formation of red candles. Red candles will increase with bigger lengths in size, and the green candles will be less. Red candles or more red candles mean the buyers are not interested to push the markets toward the upward direction. Now, if someone's new here, please note, if you want to make money from a buy trade, you will make money when the prices of an asset or instrument increase in value. And there's an opposite of a buy. It's called short selling. Short selling, if you don't know what it is, it's a homework for you. You can just go on YouTube or social media, just write down what is short selling and get to know it. Short selling is opposite of buy. In short selling, you make money when the prices fall. So you can trade in both directions. It's just for the time being, short selling is an opposite of buy. Okay. So let's go to our PowerPoint without wasting further time. What is price action? Price action trading is like reading the story of a stock by looking just at its price movements. We're looking what the price of that asset is doing at the current moment and how was its history few minutes ago, few hours ago, few days ago, few weeks ago. Instead of relying on fancy squiggly lines and indicators, you focus on the ups and downs, the jumps and the dips of the price itself. There are two kinds of important traders. There's something called retail traders and there's something called corporate traders. Retail traders are individuals and corporate traders are institutions that inject heavy funds, multi-billion, multi-trillion dollars on daily basis. Who are the corporate traders? These are your retail banks, central banks, state banks, investment brokers. These are the big boys who are the market makers, who are the market movers. They are the one who create big volumes, big swings in the market on daily basis. So there are two kinds of traders. Now, there are different kinds of trading strategies. There's something called a mechanical trading strategy. A mechanical trading strategy is a strategy in which the traders, they use indicators to know the trend, to enter and exit the markets. That's mechanical trading strategy. No emotions used. For example, the famous 200 moving average, if a candle closes above it, you buy. If it goes below, you take a short sell. This is a mechanical trading strategy. The price action traders, they do not use any indicators at all. they purely depend on the chart and the patterns that form within the chart. The patterns are the ones that make price actions traders money. We're going to discuss 3 important patterns. Probably if you get exhausted, maybe we could take a 5 or 10-minute break for question and answers, then we'll learn more, or we can postpone it to session number 2. Okay, let's move further. So now we've talked what how many types of traders are there and what are the different types of trading strategies. I've mentioned mechanical trading strategy. I've mentioned about price action trading strategy. There is also something called automatic trading strategy. That's a separate topic. So they might see the price is going up and down in repeating pattern, like a detective following a trail. Okay, or they might see a big jump, like detective finding a big clue. All these big moves that happen in the market, a green spike towards the upward direction, a red spike moving towards a downward trend. You know, these are the clues for price action traders and price action analysts. These patterns can hint whether the price is likely to go up more, buy. If it's going too much up, they want to buy. If it goes too much down, they would look for certain patterns to short sell or exit their buys, or just keep bouncing around. Wait and see. It's all about understanding the price's language. These zigzags that we talked about today on the whiteboard, there's a way to interpret these. You know, you can learn these, you can work with these. We have something called support and there's something called resistance. Maybe you all are very familiar with this, but today I'm going to give you a definition, and I'm very sure you haven't heard about this definition ever before. Here is it. You can write it down if you wish. It's not in the slide. Support is an area where the prices are cheap. Resistance is an area where the prices are expensive. When it's cheap, from the support area, prices always bounce and move towards the upward direction. Support is an area where buyers come as greedy players. They jump, they want to hop on, green candles start forming, and the prices rocket towards the upward direction. This is support. So support is an area where prices are cheap. Support is an area where buyers are strong. Support is an area where green candles are more than red candles. Okay? Resistance is an area where prices are expensive. Resistance is an area where prices are expensive. Resistance is an area where the red candles are more. Resistance is an area where buyers are weak. Resistance is an area where buyers are weak. Resistance is an area where red candles will be more. Resistance is an area where buyers take their profit. They remove their money off the table. This is some kind of new definition for you for support and resistance. Am I being too fast? Sometimes I get excited and so I start speaking quite fast. You know, is everything okay? Is it clear so far? Don't worry about the strategy. Don't worry about the technique. We're going towards that direction. Is the pace of presentation okay? Are you guys okay? Thanks, Mr. Amir. What about others? Is it okay? Are you grasping? Is it boring? Slow down a bit, no problem. Is there something that you want me to repeat, Miss Anusha? Do you want me to repeat something? By the way, if I'm fast, you didn't understand anything, you can ask me, I'll repeat it for you. I don't mind questions at all. Thanks, Mr. Rajiv. Red candles and green candles. Green candles indicate buyers. I will show you this on the chart. When we go to the trading platform, I'm going to show it there. The green candles are positive candles. They are also called bullish candles. Green candles indicate that the buyers are strong, buyers are in control, and they're trying to push the prices upwards. Okay. Red candle means the market is in a negative pressure. The market is trying to fall down. There are no buyers. There are short sellers. Who are short sellers? Short sellers are the bad boys who move the market towards the downward direction. Okay, Ms. Anusha? I hope it's clear. All right. Good. It's good to have questions. I like questions. I love questions. No question is silly question. No question is a bad question. A question exists because there's a problem to be solved. And this is our philosophy at NCM. We are here to solve your problems and give you decent, reliable solutions and credible services. Okay? So let's move further. Let's move further. Okay. First of all, these are 4 important strategies. Now, let me tell you something. Let me give you a tip. I cannot be a doctor in the morning and engineer at night, or I cannot work as accountant in the morning and a project manager at night. It's impossible. When it comes to trading, online trading is just like a business. Your mobile phone that you're trading on, the laptop that you're using, the computer you have at home for using, this laptop, computer, tablet, iPad, whatever it is, this is your business instrument. It's your shop, it's your company, it's your office, it's your showroom, whatever you want to consider it. This is now my personal opinion. It's up to you how you use this next statement I'm going to say as per your needs. My personal suggestion is focus on one trading product, master it, and specialize in it. Point number one, focus on one trading product in the beginning as a beginner until you have a grip, master it, specialize in it, and just destroy learning it. Second thing, there are so many trading methods. There are so many trading strategies. Some are available in the form of books, some are in the form of YouTube videos, whatever it is. Focus, specialize, and practice one strategy and work on improving it. Sometimes the methods are good, the strategy is very credible, reliable, result producing, but because of influence or peer pressure, this is something we call strategy hopping. Somebody just suddenly sees a video saying, make $100 into 10,000, make 10,000 to 1 million. When you keep shifting your focus, your bias of your psychology changes, you will lose track. And this is where the people, they give up. No, it doesn't work for me. It's not for me. It's very depressing. No, if you use a focused approach on one trading product, one chart time frame, one strategy, and practice enough on it, you will have a very strong and decent grip. There's a very famous saying, even it's usually on social media as well. Bruce Lee, he says, I'm not afraid a person who knows 1,000 kicks. I'm afraid of a person who's practiced one kick 1,000 times. Okay, so you will require focus, and the definition of success is few simple disciplines practiced every day. Few simple disciplines practiced every day, it will lead you to success. One chart pattern, one time frame, one good, decent, regulated broker. Make sure it's in your own country. They have a physical office, of course, like ours. Okay. One method. You get the point. You can work it out, right? Now, let's go and continue. There's something called a head and shoulders pattern. Then second one is the engulfing candle. Third one is the inside day candle. The fourth one is the 3 white soldiers and 3 black crows. It's okay. If you're getting confused, it's totally fine. I'm going to make these things easy for you. Like I shared with you before, that the prices, the market, it moves in symmetry. It goes like this in zigzags, up and down, right? I just randomly drew these lines. Can you see this area here? Just look at this. Just look at this section. Just look at this box for now. A head and shoulder pattern in a chart, it looks like this. Market buyers push the prices up. Everyone, please focus and pay attention. I'm going to teach you something cool. A lot of people talk about head and shoulders, but they don't know how to explain it. But we can explain it in a very special way. Buyers are moving the prices towards an upward direction. Within this line, you will see green candles being formed. Sellers come and say, no, the prices are expensive. Go down a bit. Go down. More than enough. Buyers give a final push. They try to beat the sellers. The sellers are strong here now. Sellers bring some more friends. They push the prices down. The buyers try one more time. Sellers say, no, this is not happening. You're not going up anymore. The place that you should go is in a downward direction. This is what a head and shoulder looks like. This is the head, these are the shoulders, and this is something we call the neckline. This neckline is also considered as a support area, and the sellers, the short sellers, would enter a short selling trade. The sellers will enter a short selling trade, and they would place their stop loss around this area or around this area. What is a stop loss? What is a stop loss? Stop loss is a trading order in which you put a limit of your loss. You set a limit. For example, I've got a $1,000 trading account and I cannot wish to lose more than $10. So I can in advance set a stop loss that if my loss reaches $10, I don't want to go beyond $10. My trade will be automatically closed and I'll be exited with a stop loss. Then there's something called take profit or a target level. Take profit is a predefined order that is placed within the trade that if I gain $10, $20, or $30, close my trade immediately. And this will teach you in next upcoming webinar during next month. It's about pending orders, how they can help people who want to be full-time traders or who want to be part-time traders. Pending orders are something cool for part-time traders because if you're busy at work or you have some responsibilities, you're not in front of the PC all the time. Pending orders are something that make sure that in your absence, if a profit is achieved, it's achieved without you closing it manually. And if there's losses happening, a small loss can be closed without your absence. That's the purpose of stop loss and take profit. We'll talk about that later as well. So we just discussed the head and shoulders pattern. This is how it looks like. If you want to see on a candle chart, this is the head and shoulder formation for short selling. Some people don't know short selling. It's totally fine. It's totally okay. This is an inverted head and shoulder. Here we have an inverted head and shoulder. Inverted head and shoulder pattern is used by buyers. Those traders who are willing to execute a buy trade, they are the ones who will use the inverse or upside down head and shoulder pattern. So you've got the left shoulder here. This line that you're seeing, this blue line, this is actually a resistance. This is a resistance. So the price shoots up. It breaks this neckline. It breaks this neckline. Okay. This area here, this breaking of this neckline is used for buy entries. And trust me, you can work on this trading pattern. And like I said some time ago, the entry patterns are different things. Head and shoulder pattern is an entry pattern, and it is to be used only at a 1 hour chart or a 30 minutes chart or below. But you can use it on any time frame you wish or you feel comfortable, but it depends on you. For short-term trading, if you want to enter short-term trading, you can use a 1 hour chart and below. Now, is the head and shoulder pattern clear? If it's not clear, let me know. I'll explain you again. Is the head and shoulders pattern clear? Let's open the trading platform. I'm going to share the screen. I'm going to share the trading platform. And we will try to see if we have a head and shoulder pattern. Let's suppose a 1 hour chart. It doesn't have to be perfect. Everyone, it doesn't have to be perfect. This is a kind of a head and shoulder pattern. Look at this. This is the first shoulder. This is the first shoulder. The next high was higher than the previous one. Okay. Control, I can duplicate the lines by holding Control key and left mouse click. Can you see that? Can you see this? This is a 1 hour chart. We have a head and shoulders pattern here. This was the neckline. It got broken. The head and shoulder traders would have entered somewhere around this area. The stop loss would have been here. And you can see it went down. I'm showing you. See, don't hesitate. Don't feel shy. If you're not understanding, it's your right to ask questions. Okay? Is this clear? Thanks, Mr. Salman. Mr. Salman is saying it's clear. What about the others? Ms. Rahma, Mr. Riaz, Mr. Salman. clear. Great. Mr. Amir is also with us. Amar Zidan. Okay, it's clear. Okay, shall I move further? Let's move further, okay? Oh, no, let's first see also an inverted head and shoulder. Thank you, Mr. Amr. Thanks for confirming. Let's look for the buy example. This is short selling example. Sometimes some people, they find short selling a bit confusing. Let's go for a short, where is the auto scroll here? Disable auto scroll. Give me a moment, please. Yeah, auto scroll is here. Where is it hiding? Here, okay, yeah, let's disable. Let's look for an inverted head and shoulder. Now, they don't really have to be perfect, okay? They don't really have to be perfect. A head and shoulder pattern for buying, it will always occur at a support level. Okay, here you go. You see this? It goes down, then it pulls back up. Buyers try to take control. Short sellers are strong. They give it one more push, and then it shoots up. This here is the neckline. Like, you know, see, here's the thing. This is an ideal head and shoulder pattern, okay? But it doesn't have to be perfect. Sometimes it can be like this. You know, it doesn't have to be perfect. Okay, so this was one for the buy example. Maybe it's not that impressive. We can look for more examples. We can see for more examples. Do we have? See, they come less, but when they come, they reward you quite well. Maybe this is also considered as head and shoulder a bit. Here. This is kind of the neckline. This is an area where the price would probably go for a buy trade with stop loss being placed here. And you know, we'll talk about this in risk management and money management. If this is the size of your stop loss, your take profit should be at least 2 times your stop loss or 3 times your stop loss. Let's discuss this in upcoming slides. Let's go back to our presentation. We've discussed the head and shoulders pattern so far. See, what we're going to do now, we will only discuss the engulfing pattern. I'll teach you an engulfing pattern, and then we will try to finish the money management, risk management part, and we'll end the presentation with your question answers, okay? I think it's going to be too much. I know tomorrow is going to be Friday, tomorrow is going to be weekend in Dubai, and you might have some commitments. We'll study one more candle pattern, and I'll show you how cool this is and how to maximize your results, your trading results, how to improve your performance, okay? So let's talk about the engulfing candle pattern. Engulfing candle pattern is also called in Arabic. By the way, I speak 4 languages, I think, fluently. I speak English, Urdu, Arabic, Russian, quite fluent. Okay, so even if you have a question in these languages, I'll be able to answer, but I have to translate them in English because today's webinar is for the English audience, okay? So what is a bullish engulfing candle? When you have a red candle, just as here, you can see in the PowerPoint, okay? This is a red candle. The next candle is a green candle, but this green candle, it embodies the full preceding or the previous red candle. It's covering it, you know, it's engulfing it, it's covering it. This is called engulfing candle pattern. It is also called cover candle, covering candle, because, you know, it's just showing it's dominating over the short sellers. We'll talk about the example. You will find an engulfing candle pattern is an entry candle pattern used by traders to enter for buying traders. A bullish engulfing candle pattern is used for buying decisions. It's used often at support. Traders Price action traders, they are hunting and looking for engulfing patterns at support areas, and when the market is in uptrend, when the market is making higher highs consistently, you see that breathe out, breathe in, breathe out, breathe in, right? During that breathe in process, they want engulfing patterns as well. So I'll show you here at the chart. Let's go here. Here, there's an example already here. You can see here clearly that the market is making higher highs. It's making higher highs. It means the market is in uptrend. The market is in uptrend. So whenever a bullish engulfing pattern was formed, traders were using that for buys. And how would you enter a buy? What's the trick, or what's the method to take a buy? Above the break of the head of the engulfing candle, a buy order is placed, or a buy stop order is placed, and below the tail or shadow, a stop loss is placed. It can be 20 pips, 30 pips, whatever. One important key tip. It's often recommended or said or practiced by professional traders. If you decide to take or execute a trade, your stop loss should not be more than 2% of your trading account. Again, the stop loss per trade should not exceed more than 2% of the trading account. The reason why most of the time people lose in the world of online trading and complain more about it, that it doesn't benefit, is first of all, lack of education, training, and practice. Second reason is poor risk management. Risk management means how much money you're willing to lose. Business is not all about making money all the time. It's making money consistently, and the losses are part of a business. Okay, if you take 2% risk per trade, it means you can trade 50 times. Okay, and how to be successful and how to be successful in these 50 times, we'll cover that in the upcoming slides. Okay, so let's talk about the engulfing candles here. So this was an engulfing candle here. Let me grab the drawing tool. This was an engulfing candle. Here would have been a buy, here would have been a stop loss, and probably the target can be even with 1-to-1 risk reward ratio. Means if your stop loss is 20 pips or 40 pips, your take profit can be 40 pips. This got hit as well. This is another entry. This is another entry with the stop loss a little bit below the swing low. Okay, what if you think about 1-to-1, this got hit as well. Okay, this one is another entry. This is also an engulfing pattern. It was not that successful. It was a loser trade. Then you have another opportunity. This is where you would have entered. You know, this is a buy example for buy. This is a short selling kind of engulfing pattern. And short selling, if you want to short sell around the resistance area, all the price action traders, they look for a bearish engulfing pattern. So I'll repeat the sentence. Price action traders who use only engulfing candle patterns for their trading decisions hunt for bearish engulfing patterns at resistance areas. Hunt for bearish engulfing patterns at resistance areas, or when the market is in a downtrend, when it's making lower lows, at this breathe in and breathe out section. This is where they would look for bearish engulfing pattern. Okay, so that's about the engulfing patterns. Let's go to the chart once more, and we will talk about the, let's take something that moves fast, probably, let's see if gold. We'll go to a 1-hour chart. Let me just clean the chart for you. Okay. You can see here, here we are in an uptrend, right? Since 13th of June, this is the gold chart on a 1-hour time frame. We are in an uptrend here from 13th June, right? So where is an engulfing candle? We have one bullish engulfing candle here. You can see that? That's an engulfing candle. That was one of the entries. And can you see what was the return? If this was your entry and this was your stop loss, okay, ideally you can trade with 1-to-1 risk reward ratio, or even if you want to go with 1-to-2 risk reward ratio and 1-to-3 risk reward ratio. This would have made money, but it's good to practice with 1-to-1 risk reward ratio, 1-to-2 risk reward ratio. I don't recommend 1-to-3 risk reward ratios for beginners at all. Okay, so this was the first one. Then, do we have a second bullish engulfing candle pattern? Yes, we have it here. Did it work out? Did it work out? Let's check it out. Maybe it did, maybe it didn't. So even if it got stopped out, it's totally fine. It's part of the process. Let's say you lost on this trade, but look at the next trade. Here you have another bullish engulfing candle pattern. You see, the green candle is covering the previous red candle. You see, it covered your loss, maybe gave you additional profit on top of it. This was for bullish example. Let's talk about bearish example. Bearish example, you should look at resistance areas when the market starts to drop towards the downward direction or the market is in a downtrend. So let's go to maybe 20 May. Let's go to 20 May and see, look for the patterns around that time here. Let's zoom in a bit. We're going to zoom in a bit here. Okay, so the downtrend has started finally from this area. Let's look for bearish engulfing candle pattern. This one is your bearish engulfing candle pattern. Can you see that? Then you have another bearish engulfing candle pattern. Then you have here another bearish engulfing candle pattern. Another important tip, if the market is not clear, if you're not understanding the chart pattern, don't force yourself to trade. If it's not clear, forget it. How we have a slang, khali wali. You know, ignore and do not continue further. Just re-enter or make a decision when you feel comfortable, when the pattern looks clear. If you're confused about the pattern, skip it, okay? And don't regret it. So this was an example of a bearish candle pattern. You have, do we have more? We have many. So we have learned from today's session that it's good to, when you should look for bullish patterns and when you should look for bearish patterns. So I hope these are sufficient examples and I hope you're enjoying and learning something. Now there's a question here from Mr. Riaz and he's asking which time frame is good for price action trading. In my personal opinion, the best time frame would be if you want to be a bit fast, you want to be in action, a 1 hour time frame would be better. A 1 hour time frame is good, but if you want to take it easy and slow, go for a 4 hour chart or a daily chart. That's going to help you if you're someone who wants to trade part-time or you're someone who cannot be on the computer round the clock. Okay. So let's go back to our presentation. We're going to wrap it up very soon. People, I hope you've downloaded the platform. We are not going to cover this. These are for next time. Now, let's talk about money management. What is the meaning of money management? Money management means when you have a trading capital, how many portions are you going to split it into? For example, a person receives a salary, he distributes his salary in 4 portions, one for his salary, one for the parents, one for the wife, one for savings or investment, right? But it is good to distribute your trading capital in 50 portions or 30 portions and always trade with 1-to-2 risk reward ratio. What does 1-to-2 risk reward ratio mean? Think of this example. Let's flip a coin 10 times. Heads, if it's heads, I win 100 dirhams. If it tails, I owe you 100 dirhams. If we flip the coin 10 times, we will be at almost at break even. I'll take 50 dirhams from you, I'll give you 50 dirhams as well. Done. Equal. This is 1-to-1 risk reward ratio. But what if we have this kind of deal? If you win, I give you 100 dirhams. But if you lose, you owe me 50 dirhams. So now, even if we did 10 times, if you lost 5 times, maybe you lost 250 dirhams. But if you win, you will win 500 dirhams, 2 times your stop loss, 2 times your risk. When you trade even like this, most of the time your trading results will improve. So just because this is part 1, we are not going to go into its details. First and most important thing, make sure when you're trading, your take profit level is twice the size of your stop loss. I've demonstrated. This video is being recorded. It's being recorded, and it will also be available for revision. Okay, you can contact our offices to request a recording tomorrow, and they will give you the link of this video immediately. Okay, if you've joined late, it's totally fine. If you think you want to revise it, you'll get the video link automatically. So let's go further. So this is the purpose of 1 to 2 risk reward ratio. If you trade with 1 to 2 risk reward ratio, you only have to be correct 34% of the times. If you took 100 trades, 66 of them probably were losers. If 66% of them were losers, it's fine. But if you only won 34 trades, you would still be either at break even or slightly in profit. So that's the power of trading with the proper risk to reward. Often people trade wrong. The newbies or people who didn't have proper training, what they do, they have a stop loss of maybe 100 points, but take profit of just 1 or 2 points or 1 or 2 pips. They're doing exactly the opposite. This is one of, if you understand this table and stick with one risk to reward ratio method, you can consider that this table is the secret sauce of when it comes to winning. This table, just take a screenshot if you can. If you're on your mobile phone, if you're on your computer, just hit the print screen button on your keyboard. Keep this picture with you. And similarly, you can take a screenshot here as well. I'll just pause for, I'm going to count to 5. 1, 2, 3, 4, and 5. I hope you've taken the screenshot. Here's another slide. This will clarify for you the importance of risk to reward ratio. And let's end the session. These are our addresses. If you're in UAE, we are at Sheikh Zayed Road in Dubai, United Emirates, in Al Mazaya Shopping Center. Okay, you can visit our office. The part 2 of this session will be hosted in our Dubai office as well. To know more about the upcoming training program and part 2 of this session, you can just call your customer accounts manager, or you can contact the office directly. If you're joining us from Kuwait as well, we are in Dar Al Awadi Tower on the mezzanine floor in Sharq. The number is also there. The website is also there. Just contact your account managers to know about the second part, And I believe the requirements for being part, if you become, if you open an actual funded trading account with NCM Financials during the upcoming weeks, and it's funded and active account, you are eligible to join part 2 for free. And secondly, you can also request 1 or 2 free sessions for one-to-one coaching on Zoom. You can ask for private sessions once you become a customer with NCM Financials. Okay, here's the final slide. Here's the criteria. Clients with a funded live trading account are eligible to apply. Please contact our customer service via live chat at ncmfinancials.com. Email is training@noorsimacademy.com. Telephone is this. Now, last thing about the competition. In the beginning of this webinar, we requested you to go to the website of NCM Financials and download the MetaTrader 5 trading platform. Download this platform, install it, and take some trades based on price action strategies on a demo account. Make sure you use a demo account, and your results will show here in the history. Your results will show here in the history. The winner will be announced on our social media platforms and maybe the website as well, and will be contacted for prizes and one-to-one sessions as well. All you have to do is go to new order, execute some trades, reasonable sizes, 1 lot, 2 lot, 3 lot, whoever earns the highest amount on their demo trading platforms, just take a screenshot. Then after you take a screenshot, go to the slide, go to our email, training@noorsiamacademy.com, and email it to us, and inshallah, our team will get back to you. Thank you so much for participation and attendance. I hope you enjoyed today's webinar and you gained some value. Let's have some question and answers. If you have any question and answers, there's a reactions icon here on Zoom. Just raise your hand. I will unmute you. You can come over the microphone. If your mic has issues, you can just write your questions in the chat box and I'll answer all of your questions. If you have any questions, go ahead. Don't feel shy. Don't hesitate at all. Any questions? Come on. Mr. Salman, Mr. Viral, Ms. Anusha, Ms. Fatma, Mr. Kushan, Mr. Bhaskar. No questions? Was it easy or was it difficult? Was today's session easy or was it difficult? Easy. One person has said easy. Good. Mr. Salman says it's easy. So 3 people said easy. Trust me, it's not easy. Your trainer and presenter made it is good. You have an amazing trainer. So yeah, thank you so much. Just I'm kidding. So everyone, thank you so much and wishing everyone a lot of success. And once again, if you have any queries, you have questions in regards to opening a trading account, and you want to know more about our regulation, our licenses, if you want to have more trainings, feel free to contact us. And I'm sure you've received our official emails as well. Wishing you all a great evening. Have a great week ahead and have a great upcoming weekend. Take care. Bye-bye for now. Thank you, Mr. Salman. Thank you.